is the difference between a private equity fund and a hedge fund? Let's learn more. I'm your learning partner, Sushila Hariharan. And if you're interested in a career in global markets, investment banking, and hedge funds, do subscribe to my YouTube channel where we provide content-centric, research-focused videos on topics related to the subjects of hedge funds, investment banking, and global markets. Okay, so a common question that lingers in the minds of people is what is exactly the difference between a hedge fund and a private equity fund? So let's first start off with the broader concept of understanding the pooled fund concept. A pooled fund is when investors contribute capital to a pool of funds, and that pool is then collectively invested by an asset manager into different asset classes, which could include equities, preference shares, bonds, money market instruments, commodities, currencies, or whatever is the investment objective of the fund. So this pooling of fund, the collective contribution of capital from different investors and the investment of this capital into asset classes in different currencies in different countries is defined by the fund manager. So this concept of pooling funds, creating this combined capital or a collective capital, and then investing that capital on behalf of the investors into the markets such that the investor only knows the asset management company to evaluate the performance, etc., is a very, very common phenomenon in most mature markets across the world. So this concept of pooling capital then has what is called as investment objective. Investors identify with the investment objective and accordingly then invest in that particular pooled fund or into that particular asset management company. So the pooled funds is then given a structure as classified by the asset manager, the team of research analysts, the auditors, the compliance entities, the regulators, etc., into a single entity called as the AMC or the Asset Management Company. The Asset Management Company is then responsible for collectively taking decisions with regard to the pool of capital and then investing it into different asset classes. Now, at this point of time, how do they collect capital from different investors depends upon what is the investment objective of the pooled fund. If the asset management company, which has been formed, is going to be investing in listed equities, listed bonds, listed money market securities across the world, and they're going to trade in these asset classes, it is called as a hedge fund. Okay, so private equity funds and hedge funds both have the common following characteristics. The first common characteristic between hedge fund and a private equity fund is that both of them take capital only from accredited investors. Accredited investors are those investors who meet certain criteria with respect to income levels as well as net worth levels. So both private equity funds and hedge funds will take in capital only from accredited investors who meet this criteria of net worth and income levels. In some countries like the United States, every fund defines its own quantitative worth with respect to the accredited investors. So sometimes the fund might say that if the investor is earning $1 million and is having a net worth of $5 million, then they can be classified as an accredited investor and they can put in the capital into the fund. So the common theme between hedge funds and private equity funds are, the first point is that they both are alternative investment funds because they are representing investments only from accredited investors. They take the second point of commonality between hedge funds and private equity funds is that they take in capital from accredited investors only. They do not take in capital from retail investors. So that means every accredited investor contributes a large sum of money into a single fund. Okay, and this large sum of money literally can be as with a minimum qualifying criteria as $10 million and can go upwards of up to $100 million as well. So these 2 points of commonality, that is hedge funds, between hedge funds and mutual funds, that is both of them are alternative investment funds, AIFs. Second is both of them take investments only, take capital contributions only from accredited investors, are the only points of commonality between hedge funds and private equity funds. So let's now define what is the differences between a hedge fund and a private equity fund. Private equity funds are structured to represent capital contributions that are going to be invested collectively into unlisted stocks. These stocks could be at different stages of the company's growth, except that these stocks cannot be listed on a stock exchange. So when a stock is listed on a stock exchange, it is called as public equity. Why is it called public equity? Because it's listed on the stock exchange and retail investors can directly buy the stocks from the stock exchange. These stock exchanges include NSE/BSE in India, NYSE, Nasdaq in the US, LSE in the UK, and Tokyo Stock Exchange in Japan. So all of this represents listed stocks. So companies that have not yet been listed and go through multiple rounds of fundraising, Series A, Series B, Series C, etc., are called as private limited companies because their stocks are not yet listed. So they are private. And how do we know they are private? Because they are registered as the same, either as PVT private or PLC, etc., depending on which country you're in. So private limited companies' stocks are not listed. The capital is held by a few investors, which include founders or promoters, as well as private equity funds. So private equity funds exclusively invest only in unlisted stocks. If they're investing in unlisted bonds, they're called as private credit funds, but private equity funds otherwise list only in unlisted stocks. So this is defined where? In the investment objective, which is mentioned in the pitch book or in the offer document at the time of capital raising by the general partner from different limited partners or different accredited investors. As opposed to this, hedge funds will invest only in listed stocks across different markets, across different countries, depending on what is the hedge fund trading strategy. It could be a macro hedge fund, it could be a multi-strat fund, whatever it is, it's going to be investing exclusively in large volumes in these equities that are listed in different markets of the world. So private equity funds invest in unlisted stocks, hedge funds invest in listed assets. Second, private equity funds capital flow into the fund happens at staggered intervals. Okay, this is called as the concept of understanding that capital is first committed, then the capital call happens, and then the capital is contributed, and then the capital flows into the fund. Okay, so even before the capital comes into the fund, there are multiple stages of capital commitments that take place, so that the GP, that is the asset management company, is very clear about how the funds are going to be invested or where the money is going to come from. Okay, if they don't know where the money is going to come from, they really can't start a PE fund. Okay, because fund means you're contributing your capital as well as others capital, or else you're going to be a family office, right? The second contribution is that of a hedge fund. A hedge fund, on the other hand, typically is allowing subscriptions into the fund at multiple points of time, and capital comes into the fund. The third point is what happens is a private equity fund open-ended or closed-ended. The private equity funds are closed-ended. Okay, they do not, once the capital is contributed, the investors stay committed in the fund for a certain period of time. They stay locked into the fund, and only when the fund winds up does the profit distribution take place between the general partners and the limited partners. On the other hand, hedge funds are almost always open-ended, allowing investors to put in capital into the fund as well as taking out the capital from the fund. So activity in a hedge fund is more regular, is more frequent, is more transaction driven, because there's continuous capital flow into the fund and capital flow out of the fund because of the nature of it being an open-ended fund. Okay. Fourth point of distinction between a hedge fund and a private equity fund is hedge fund investors do put in all the capital into the fund at multiple points of time. Okay, whereas a private equity fund investor typically will put in a portion of the capital initially. After a couple of years, they will again put in some more capital, and at the third point, and that's the capital contribution by the private equity investor into the PE fund. By the investor into the PE fund is more dependent upon whether the asset management company has identified enough companies to be able to invest in and thus get capital contributions from the investors into the fund. On the other hand, in a hedge fund, this kind of staggered investment doesn't happen on a commitment level. Capital is contributed, the capital is invested with the pool, and then the capital is distributed by way of profit sharing between the different investors. The fifth point of distinction between private equity funds and hedge funds is this most important aspect as to how profits are distributed. In a hedge fund, profits are distributed as and when they make the profits, but in the case of private equity funds, the profits are distributed in a particular sequence, okay, depending upon whether the private equity fund is going to be following a waterfall distribution of European style or American style. Accordingly, the private equity fund distributes the profit. So there are many differences and commonalities between private equity funds and hedge funds. Do share this video with people who are more interested in a career in investment banking and global markets. Thank you so much.